The year is 1923. In Berlin, a baker raises the price of a loaf of bread twice before noon, because by evening the same money will be worthless. Mothers carry wages home in sacks, not wallets. Children build towers out of banknotes that cannot buy a single egg. The German mark is dying in real time, and the entire country is being dragged down with it. Outside, in the cold morning air, the city still looks like a functioning society. Trams run, newspapers are printed, office workers hurry down the streets in worn coats. But beneath that thin layer of normalcy, something essential has broken. The numbers printed on paper money no longer mean anything fixed or stable. Prices move faster than pay. Contracts still exist on paper, but in daily life they are quietly abandoned. Trust, the invisible foundation that lets a nation use the same currency without thinking about it, is evaporating. Only a few years earlier, this same country had been one of the most advanced industrial economies on earth. Its engineers built cutting-edge machines. Its universities were respected. Its middle class saved, invested, and planned for the future. That future had a currency symbol attached to it. Savings accounts, pensions, government bonds, all of them were promises denominated in marks. As the mark disintegrated, those promises went with it. What was happening in Germany was not a random accident. It was the end point of a path that many nations have walked before and since, a path that can be understood as a series of stages. At first, inflation is a tool, used carefully, almost surgically. A government under pressure chooses to borrow more, spend more, and tolerate a little more price growth than is comfortable. The reasoning is always the same: to buy time, to smooth over a crisis, to avoid pain today in exchange for a cost that will supposedly be paid tomorrow. As the years pass, temporary measures become permanent habits. The state discovers that citizens will accept more inflation than expected, so long as it is gradual and explained away. Politicians learn that it is easier to expand the money supply than to raise taxes openly. Voters are told that growth will outpace debt, that clever management will prevent serious damage, that the system is sound. Eventually, the gap between what a government promises and what the real economy can deliver begins to widen. Debts accumulate, deficits become normal. As that gap widens, the temptation to lean on inflation grows stronger. Currencies do not collapse because of a single decision. They erode through a long sequence of rationalizations. By the time a nation reaches what can be called stage 4 of this process, the situation has fundamentally changed. Inflation is no longer a side effect or a tool to manage business cycles. It becomes a structural necessity. The government cannot afford to stop. If it slows the printing presses, the hidden insolvency of the system begins to surface. If it continues, prices accelerate and trust in the currency weakens further. At stage 4, every choice carries a cost that can no longer be disguised. Weimar Germany is one of the clearest historical examples of what stage 4 looks like when it finally breaks into the open. War debts, reparations, and political chaos all played their part, but beneath those surface causes lay the same mechanism: a state that had become dependent on destroying the value of its own money in order to survive a little longer. The result was not just higher prices, it was the breakdown of a shared economic language. A mark in the morning was not a mark in the evening. Under those conditions, planning becomes impossible. Business owners no longer think in terms of building value over 10 or 20 years. They think about surviving the next 10 or 20 days. Workers rush to spend their wages immediately, knowing that hesitation is punished. Long-term agreements are rewritten or ignored. The very idea of saving for the future begins to feel naive. In such an environment, social trust erodes alongside monetary trust. People begin to look for scapegoats. Political extremes, which once seemed unthinkable, become plausible. This is the deeper danger of advanced inflation. It is not simply that prices rise, it is that the basic coordination mechanism of a modern economy, a stable unit of account, stops functioning. When that happens, power shifts. Those closest to the sources of new money, or those with access to hard assets and foreign currencies, can shield themselves. Ordinary citizens, whose lives are priced in the local currency, cannot. The story of Stage 4, inflation, is not confined to Germany in the 1920s. Versions of the same pattern have appeared in other regions and other centuries. The details differ, the slogans change, the excuses are updated for each era, but the core structure repeats. A government under pressure chooses the path of least resistance. A little more inflation, a little more borrowing, another program financed by money that does not yet exist. Each step seems manageable. Taken together, over years or decades, they form a trap. This trap has 5 broad stages, from subtle erosion to outright collapse. In its early phases, the process is almost invisible to most citizens. In its final phase, it becomes impossible to ignore. The critical point, the turning of the key in the lock, is Stage 4, the moment when a nation discovers that it can no longer return to monetary discipline without triggering an immediate crisis. This is not a story about a single country or a single decade. It is about a recurring pattern in how states, markets, and societies respond to pressure. The sequence of decisions that lead from manageable inflation to structural dependence on currency debasement, and the narrow margin for escape once a nation crosses into Stage 4. To understand how a country reaches that point, it helps to start at the beginning of the cycle, when inflation is still quiet enough to be explained away. In the first stage, the erosion is subtle. Prices rise slightly faster than wages, but only by a small margin. Officials call it healthy, even desirable. A little inflation, they argue, encourages spending, discourages hoarding, and lubricates the gears of growth. Central bankers repeat that the situation is under control. The public still believes them because past experience tells them they should. In this early phase, the damage accumulates in slow motion. Savers notice that their money buys a little less each year, but the change is gradual enough to be tolerated. Government debts, on the other hand, become easier to bear in nominal terms. Each year of mild inflation quietly reduces the real weight of what the state owes. The incentive is clear: tolerate a small, continuous loss spread across the entire population in exchange for political breathing room. Most citizens do not see the trade being made. They only feel that life is slightly more expensive than it used to be. The second stage begins when inflation stops behaving as expected. External shocks, structural weaknesses, or years of accumulated imbalances push prices up faster than planned. What was once a manageable rate becomes uncomfortable. At this point, governments face a choice. They can admit that the model they relied on no longer works and accept the political cost of tightening, cutting spending, raising interest rates, and allowing weaker institutions to fail. Or they can search for explanations that justify delay. Historically, delay is the more common choice. Leaders blame foreign speculators, greedy businesses, or temporary disruptions. They insist that once a particular crisis passes, stability will return. Official statistics are presented as proof that the situation is improving, even when lived experience suggests otherwise. This is the stage of denial, when maintaining confidence becomes more important than confronting reality. Businesses adjust not just prices, but their entire way of operating. Long-term investment gives way to short-term positioning. Companies that once focused on producing value begin to focus on surviving volatility. Instead of planning new factories or research projects, managers devote their energy to navigating exchange rates, credit shocks, and shifting regulations. The financial system twists around inflation like a tree growing around a metal fence. For households, this structural distortion is felt as a continuous pressure to keep up. People seek second jobs, side incomes, speculative opportunities. Real estate prices detach from local wages. The stock market rises in nominal terms, but only because the measuring stick is shrinking. Inequality deepens, not only in wealth, but in psychological outlook. By now, the state is usually entangled in the same dynamics it helped set in motion. Tax revenues depend on nominal values that rise with inflation. Welfare programs, subsidies, and public wages must be adjusted upward to maintain social stability. Each year, more of the political system's energy is spent managing the consequences of earlier decisions. The entrance into the fourth stage is not announced with a single law or a dramatic speech. It is recognized only in retrospect, when it becomes clear that the authorities no longer control events, but are being pulled along by them. At this point, inflation is high enough that expectations change. People begin to assume that prices will continue to rise rapidly. They adjust their behavior accordingly, and by doing so, they help make those expectations real. Businesses raise prices in anticipation of their own higher costs. Workers demand wage increases, not just to catch up with the past, but to preempt the future. Contracts are written with built-in escalators. Money accelerates its own destruction. In this environment, credibility is the most valuable and the most fragile resource a government possesses. If citizens believe that a painful but serious stabilization plan will be carried through, there is still a chance to slow the process. If they suspect that any promise of discipline will be abandoned at the first sign of resistance, confidence collapses. The state finds itself trapped between the demands of financial markets, which insist on higher interest rates, and the demands of the population, which cannot tolerate further decline in living standards. Every policy choice becomes politically costly. Doing nothing is costly as well. That is why Stage 4 is best understood as a zone of no good options. The numbers on official spreadsheets may still suggest that recovery is possible, but the social and political capital required to execute that recovery has already been spent. The idea of short-term sacrifice for long-term stability depends on a minimal level of trust, not only in the currency, but in the institutions that manage it. Once that trust is gone, even technically, sound reforms fail. Measures that might have worked a decade earlier now trigger panic. History offers many variations on this theme. In late imperial Rome, repeated debasement of silver coins gradually transformed a disciplined monetary system into a patchwork of unreliable money, fueling military unrest and civilian hardship. In more recent decades, countries in Latin America endured cycles of high inflation and devaluation as governments attempted to reconcile social promises with shrinking productive bases and external debts. In each case, the path to crisis was shaped by local circumstances, but the underlying logic was similar, a long series of decisions that made reversing course more painful than continuing along the same trajectory. What finally follows, Stage 4, is not always the same. Some nations stumble into outright hyperinflation, where prices race ahead so quickly that money becomes almost meaningless. Others impose abrupt, severe stabilization programs under the guidance of external lenders or new political regimes, exchanging short, sharp pain for the chance at rebuilding. In extreme cases, old currencies are abandoned entirely and replaced with new units, pegged to foreign money or to hard assets. Whatever form it takes, the fifth stage is not a return to the previous normal. It is a reset built on the ruins of the old system. For the individuals living through these transitions, the academic language of stages and structures is stripped away. What remains is the concrete reality of changed lives. Savings accumulated over decades vanish in a few years. Career plans that once seemed solid dissolve as entire sectors shrink or disappear. Families rethink what security means when a bank balance can no longer provide it. Out of this disruption, new habits and new institutions emerge, but they carry the imprint of what came before. A memory of the moment when the numbers everyone trusted ceased to hold their meaning. Governments rarely admit in public that they have entered this zone. Official speeches still describe inflation as a temporary challenge. Reports are filled with projections showing a gentle path back to stability over the next several years. Charts slope downward, models converge, confident surveys are cited as evidence that the worst is over. Yet away from the cameras, the private conversations are different. Finance ministers, central bank governors, and senior advisors stare at the same numbers and quietly acknowledge a fact they do not dare to say aloud. There is no painless way back. Inside the central bank, the dilemma is clearest. On one side of the balance lies the textbook solution. Raise interest rates aggressively, withdraw excess money from the system, allow over-leveraged borrowers to fail, and accept a recession as the cost of purging accumulated distortions. On the other side lies the political reality. Higher rates threaten to detonate the very structures the state depends on. Heavily indebted governments face spiraling debt service. Overextended corporations confront bankruptcy. Housing markets, inflated by years of cheap credit, begin to crack. Households who bought at the peak realize that their largest asset is now sliding in value just as their cost of living rises. What looks, on paper, like a policy tool becomes, in practice, an explosive device. At stage 4, this tension becomes unmanageable. Every incremental increase in interest rates triggers outsized damage, while every pause or reversal feeds renewed price pressure. The monetary authority finds itself accused simultaneously of doing too much and too little. Politicians demand support for growth and jobs. Investors demand proof of seriousness in fighting inflation. Each decision alienates one side or the other. Over time, the institution that was designed to stand above politics is pulled down into the arena, its reputation eroded by every compromise. Fiscal policy is caught in a similar bind. Years of expanding commitments to pensions, healthcare, subsidies, public sector wages, and debt guarantees have created a structure that assumes low borrowing costs and stable growth. When inflation undermines both, the choices harden. To cut spending risks social unrest and a visible decline in living standards. To raise taxes risks shrinking the productive base and accelerating capital flight. To do nothing requires financing the gap with ever more aggressive borrowing, which in turn pressures the central bank to keep money cheap. The result is a loop. Deficits feed inflation, inflation feeds higher nominal interest rates, and higher nominal interest rates feed larger deficits. History suggests that by the time a country has been operating in this mode for several years, something more fundamental than policy has shifted. Stakeholders across the system have adapted to the new environment. Businesses structure their balance sheets around the expectation that money will lose value. Governments design programs assuming that nominal GDP will continue to rise rapidly. Banks hold assets that make sense only in a world of negative real interest rates. Any attempt to restore genuine price stability threatens these arrangements. Stability, in the old sense, would reveal who is insolvent. This is why stage 4 behaves less like a phase and more like a trap. The very act of trying to reverse it exposes hidden weaknesses that accumulated during the earlier stages. Political systems that have grown used to promising more than the underlying economy can sustainably deliver are forced to confront disappointed expectations. For elected leaders, the temptation is to delay this reckoning for as long as possible. There is always another election cycle, another external shock to blame, another technical adjustment that buys a little more time. What disappears year after year is not only purchasing power, but the credibility of the promise that things will be brought under control. In some countries, the turning point arrives in the bond market, on screens watched by traders far from the streets where prices are rising. Yields spike, indicating that lenders are no longer willing to accept the previous terms. A refinancing operation fails. A routine auction attracts insufficient demand. Suddenly, the cost of rolling over existing debt jumps. In response, governments announce emergency measures, austerity packages, or appeals for international assistance. Each announcement is framed as decisive. Each one comes a little too late. In others, the breaking point is social rather than financial. A rise in food prices ignites protests. Public sector unions refuse further wage restraint. Transport workers strike, paralyzing the flow of goods and people. As trust in the currency weakens, informal alternatives spread: foreign banknotes, barter arrangements, commodity payments. What began as a technical issue of monetary management becomes a crisis of legitimacy. Citizens question not just the competence of their leaders, but the fairness of the entire system. When analysts say that nations do not escape stage 4, what they mean is that the original configuration of promises, institutions, and expectations does not survive. Something must give. In some cases, a new political coalition comes to power with a mandate to impose harsh stabilization, trading short-term pain for the possibility of rebuilding. In others, change is forced from the outside by creditors who set conditions for continued support. Occasionally, collapse opens the door to more authoritarian control, with capital restrictions, price controls, and surveillance used to contain the fallout. Whatever form the response takes, the system that emerges is qualitatively different from the one that entered stage 4. The individuals who navigate these transitions often describe a sense of disorientation. Prices move in ways that no longer connect to familiar reference points. Professional skills are revalued overnight. Some become suddenly scarce and lucrative, others obsolete. Political language shifts rapidly as old slogans lose their power, and new narratives rush in to explain what went wrong. In the background, the memory of a more stable era becomes a kind of benchmark and a source of quiet resentment. Those who owned assets during the inflationary surge may emerge wealthier in nominal terms, while those who relied on wages or fixed incomes find themselves permanently behind. Seen from a distance, these patterns can be plotted on timelines and measured with statistics. Up close, they are experienced as a series of personal adjustments: moving savings into foreign currency, delaying a major purchase, emigrating for work, accepting that a pension will not stretch as far as planned. The numbers that fill economic reports are aggregates of these decisions. By the time those numbers are published, the underlying choices have already been made, one household at a time. For modern economies with deep financial markets and sophisticated institutions, it is tempting to believe that such outcomes belong to the past or to other regions. Advanced models, independent central banks, and global capital flows are assumed to provide a buffer. Yet high levels of debt, aging populations, and geopolitical shocks have pushed many developed states closer to the edge of the same dynamic. Their inflation rates may not reach the extremes of historical hyperinflations, but the structure of the trap is recognizable: a dependence on cheap money, a reluctance to confront the arithmetic of promises, and an unspoken hope that growth will arrive in time to make the contradictions disappear. The lesson from previous episodes is not that every inflationary surge ends in spectacular collapse. Some are contained at considerable cost. Others fade as external conditions improve. But once a state has relied on sustained elevated inflation to manage its obligations, once it has crossed into stage 4, the path back to the old normal is rarely open. Instead, nations are forced to construct a new equilibrium on the other side of a shock. Whether that shock takes the form of a crisis, a negotiated restructuring, or a long grinding adjustment that quietly rewrites the social contract. For anyone trying to understand where their own country stands today, this framework is not about prediction, but recognition. The 5-step inflation trap is a way of seeing how small decisions taken under pressure can create a structure that no one intended and few can control. It shows how a tool meant to buy time can harden into a dependency, and how that dependency resists reform that does not confront its core, the mismatch between what a society demands and what its productive base can sustainably support. In the early stages, this mismatch can be smoothed over with optimism and engineering. Financial innovation can spread risk. International capital flows can mask domestic weaknesses. Statistics can frame deterioration as temporary noise around a long-term trend. As long as trust holds, the system can carry contradictions, but trust is not an infinite resource. It is built slowly and spent quickly. Each time a promise is bent to accommodate the needs of the moment, a fragment of that trust is consumed. By stage 4, the bill for years of such decisions arrives. The numbers on balance sheets and in government budgets still convey an appearance of solidity, but the underlying assumptions have been stretched beyond credibility. Growth projections require conditions that no longer exist. Demographic trends weigh on productivity. External shocks become more frequent. Underneath the surface, private actors adjust, moving capital abroad, shortening contract durations, indexing agreements to anything other than the domestic currency. The official narrative insists on continuity. Actual behavior signals preparation for a break. At that point, the question is no longer whether the system will change, but how. History records episodes where the adjustment took the form of open collapse, with currencies abandoned and regimes overturned. It also records quieter endings where high inflation slowly declined, but left behind a leaner, harsher order, weaker safety nets, diminished public services, and a landscape marked by deeper stratification between those who could hedge and those who could not. In every case, the transition involved a transfer of real wealth and power, even when the language surrounding it was technical. The lesson is stark. Money is an agreement before it is a set of numbers. When that agreement is strained by repeated attempts to escape the arithmetic of scarcity, inflation is the mechanism through which reality reasserts itself. The stages of the trap are stages in the erosion of that agreement. Stage 1 tolerates a little erosion. Stage 2 denies it. Stage 3 adapts around it. Stage 4 depends on it. Stage 5 emerges from whatever is left after the agreement truly breaks. From a distance, this can be plotted as a cycle. From within, it feels like a series of emergencies, each demanding compromise with principle to avoid immediate pain. That is why nations never escape stage 4 intact. By the time they recognize the pattern they are in, too many interests are tied to its continuation, and too much trust has been spent to support a decisive break. What comes after is not the restoration of the old order, but the construction of a new one on altered ground, shaped by the memory of how the last system fell when its money could no longer bear the weight placed upon it.